record actually. So I'd like to welcome you all to our second webinar in our All-Ireland Labour Market series. So I'm Annmarie O'Kane. I'm with the Centre for Cross-Border Cooperation, and I'm joined today by Rose Tierney, a tax specialist in UK and Ireland, and also John Lucas, who specialises in pensions. So this event follows a study that Rose and I co-authored alongside Maureen O'Reilly, an independent economist, and Anne Devlin from the ESRI. The study, Lisa, we might move on a slide if that's okay. So the study was commissioned by LEAF, the Labour Employer Economic Forum, and the Shared Island Working Group. It's a very in-depth assessment of what it means to live, to work, and to employ people on a cross-border basis. It is very detailed and it can be downloaded from the Centre's website, crossborder.ie. So we'll just move on a slide now. The study touches on the levels of mobility, the flow of people across the border. And this slide just captures a few of the stats that's within the report. We see millions of traffic crossings and train passengers. We see estimates of 25,000 people crossing the border to live, to work and to study, and estimates of 18,000 crossing the border just for work. So these figures are likely to be an underestimate, though we would think that it's quite likely it's an underestimate. The study also mentions that over 20%, over 80% of cross-border workers live in the border region, which is not at all surprising. So the study explores a range of topics, a very wide range. We looked at tax and pensions, social welfare, qualifications, the free movement of workers, so think visas and all the rest, remote working and collective bargaining, and trade union coverage. Throughout the topics, though, we found two overarching challenges, areas of concern, if you like. The first one is information failure. Employers and workers find it exceptionally difficult to find the information that they need to work, to employ, and to operate on a cross-border basis. That was throughout the topics. Also, divergent or changing and divergent legislation and policy between the two jurisdictions were areas of concern too. So the impact of rules and regulations does not stop at the border. We know that it ripples across the border and that it's crucial that legislation is border proofed. So today we're going to look at two of the chapters, and we have Rose with us who will guide us through taxation and John through pensions. So Rose, I'm going to pass over to you, and if you would tell us where you're from as well, set the scene too. Thanks a million.
Okay, thank you, Annmarie. I think I may have been the gremlin in the system there. I couldn't get the right link. So hopefully no more gremlins. Yeah, I'm a cross-border tax advisor. I mean, I'm qualified in both the UK and Ireland in tax, and I've been working in this area for 25 to 30 years. So it was a pleasure to work with Annmarie, Maureen and Anne on this report, because it's something that's sort of close to my heart here, based on the border and advising people on the border, both businesses and individuals. So a lot of the stuff we're talking about here, a lot of the attendees will be familiar with some of the tax stuff, mightn't be as familiar with some of the pension stuff. So we're going to go through quite a bit today. So I want to break it down with, what are the issues, or what are the concerning areas? So there's concerns for the employer, the employee, and the fact that, there's different sort of cast between government workers and non-government workers. And so what we're going to go through is sort of the payroll requirement for employers, the risks that they see, and also then the issues for the employee, and then the differences between the government workers and over the private sector. And all throughout this, as Annmarie talked about, the overarching sort of themes that came out the whole way through the report was that it's really difficult to get the right information to actually match your facts and circumstances to that information and take the right road. And that is leading to a lot of non-compliance. And even though that's not a word that is something that is nice to be heard in government departments, it is actually leading to a lot of non-compliance. And there are global challenges and solutions to be found, from elsewhere, because we're not the only border. And that's what we've looked at as well in the report. And I'll go through sort of some of the issues that we came across and what other countries are doing about it. Can you move on there, please, Lisa? Yeah, so we deal with the employer first. So a lot of you will be familiar with this, that as soon as you step across the border as an employee, then, the employer really should be aware. And so a lot of them aren't, but they really should be aware that they've got to watch the rules in terms of whether that employee's presence across the border doing work for them is going to create an obligation for them to set up a payroll. Now, that will depend on a lot of things. It depends on whether the employee is resident on the same side of the border as the employer, or whether they're resident on the side of the border they're actually going to take up the job on, or going to carry out duties on that side of the border. So typically where this arises would be, it's almost an unconscious reaction that sometimes employers actually see it more clearly when they send somebody across the border to work on a project or to work on a site. What they don't always see is that when they allow somebody to work from home across the border, that the same rules and same issues apply. So this is where it has arisen, particularly since the COVID pandemic, where people were allowed to work from home and then wanted to continue. And the whole workplace has been disrupted and changed now that a lot of people do work from home. And that causes issues for the employer because it can create a payroll responsibility for them across the border. So if an employee typically splits their duties across the border, you could end up in a dual payroll scenario. Now, where the rules that currently exist in legislation and guidance, both sides of the border, are sort of referred to often as the global mobility tax rules. And really what they're designed to do is to allow companies to send people to other countries and to not have that payroll obligation for a temporary period for these temporary assignees. So they have a lead-in period of maybe 60 days or up to 183 days in some cases where they don't have to set up that second payroll. And those rules work really well when you're flying, your companies are flying people off the island. They're going to Britain or they're going to further afield to go to any treaty country. Usually these rules apply. And there's also rules then for non-treaty countries as well. And they work very well for large companies who are flying people around the world. What they don't work for is our land border. And the reason for that is that this temporary exclusion period doesn't apply where the employer takes on a person who lives on the opposite side of the border to carry out their duties on that opposite side of the border, or allows that person to work from home on the opposite side of the border to where their employer is. Because the reliefs that are there under the Double Taxation Treaty, Article 15, doesn't cater for those cross-border workers who live on the opposite side of the border from the employer company but are posted to carry out duties in their home jurisdiction. So where the employee is resident in the same jurisdiction as the employer, no problem. They can send them and use the across the border to do work and use the global mobility tax rules, 60-day rule, the 183-day rule. But where the employee is living, where they're actually being asked to carry out the duties, and the employers on the opposite side of the border, that's where the problems arise. You move on, please, Lisa. So when there's no relief from registration available to the employer, then dual payroll often is the only thing that can be done, and it needs to be operated. But for anybody who's experienced it, it's very costly, it's complex, and it's very cumbersome. And usually, well, in the smaller businesses that I've dealt with, and some of the medium-sized ones as well, a lot of times employers have backed away from it and said, we're not doing it. And the reason for that is the complexity and the cost associated with it. I mean, there's simplifications that are there that are meant to help in those scenarios. So the real-time tax credit, which is a way to allow the taxation that's been sort of duplicated, if you like. There's a payroll on both sides of the border. This taxation has been duplicated. Where it's been duplicated, you're allowed to take a credit against the home country payroll. But that doesn't work for the land border scenarios a lot of the times that we look at, because if the employee is resident in the jurisdiction to which it's been posted, that real-time tax credit isn't available. So you can end up in awful situations where there's a requirement maybe to have a dual payroll. So part of the duties are taxed one side of the border, part of the duties on the other, or all of the duties are taxed one side of the border and part on the other. And that real-time tax credit isn't available. So it can really impact on the net take-home pay of the employee unless the employer funds it in the interim. So if the employer funds it then in the interim, that's considered a loan to the employee throughout the tax year. And what do you think happens then? Of course, that's a benefit in kind, and it's a tax charge on that. So you get into real complexity here. So the employer complication of having posted workers in the other jurisdiction can also create other issues for them. And this is something that's also, a concern of a lot of employers who sort of delve into the detail in this area, is that it could create a corporation tax presence for them. Now, it's not necessary that one employee would create that, or two employees, or 3 or 5 or 10. It depends what they're doing. It depends on their role. It depends on whether or not the employer has access to premises on the other side of the border. There's a lot of other complications there, but it's another thing that is a red flag in terms of having somebody work across the border for you, and something that employers get very anxious about, and that they don't want to create that corporation tax presence, particularly if it's a higher tax jurisdiction like the UK now is in comparison to the Republic of Ireland. So if you move on there, Lisa, we'll move on to some of the employee obligations as well. I'm sort of flying through the stuff because we've got limited time this morning, but I think a lot of you are familiar with some of the basic principles. The employee's obligations then. So the employee, if they're just a PAYE worker who works in their home jurisdiction on a payroll, then they usually don't have a self-assessment requirement, don't have to file a tax return. But if they start working across the border and they're on a payroll across the border, then so often they're in the self-assessment regime, whether that be an SA 100 in Northern Ireland or a Form 12 or Form 11 in the Republic of Ireland. So they have that self-assessment obligation to file a tax return and to declare that foreign income that they earned across the border. And they can take a tax credit for the taxes suffered across the border on the other payroll. Where you're an Irish resident employee who works across the border and commutes every day to work, and there's certain conditions like the employment has to last a period of time, and then you have got to make sure you're not proprietary director of the company, you don't own more than 15% of the shares, and you commute home at least once a week. In those scenarios, that Transborder Workers Relief can relieve the employee from paying further tax in the Republic of Ireland on the Northern Ireland employment. However, if they're, say, jointly assessed with a spouse or they have other sources of income, that can dilute the relief that's available. But that's a relief that's available on the southern side of the border, but there's no equivalent on the northern side of the border. But if they decide to have a Northern Ireland employment and they decide to work from home in the Republic of Ireland, then the Transborder Workers Relief is not available. And so they're kicked out of that relief, and they have to rely on the double taxation treaty credits. And usually Northern Ireland taxes are less than the tax in the USC combined in the Republic of Ireland, depending on what wage level you're on. So they may have a top up to pay in the Republic of Ireland in relation to their employment in Northern Ireland if they work from home. And that is something that's really cropped up as a big issue since the COVID lockdowns and then the relaxation of the rules and then the re-establishment of the rules, that a lot of employees persuaded their employer that actually I can do this work from home, but now suddenly they found this problem with the relief that they could claim. There's a very low number of people claiming that relief in comparison to the potential number of people who could claim it, because you have to file a tax return to claim it. And there's a low compliance level in relation to the number of tax returns as well. Could you move on, Lisa, please? So where the duties are split cross-border, then the dual payroll requirement often kicks in. And this is kind of other ramifications for the employee as well. When you're split between two payrolls, it can affect things like mortgage applications or access to your social security benefits. You're getting income protection insurance or health insurance. So there's a lot of knock-on effects. What employers are encouraged to do is to, make sure that before an employee agrees to have their duties split across the border on a dual payroll, is that they take advice in relation to their own personal circumstances, because every single employee is going to be different in that regard. And sometimes, taking up a job across the border can give you additional, benefits. So, maybe working on a Northern Ireland payroll when you're a Republic of Ireland resident can give you access to the Northern Ireland health care system. Working in the Republic of Ireland when you're a Northern Ireland resident could give you access to the higher level of child benefit. So there's various different advantages and disadvantages that need to be explored before somebody is split between two payrolls. So something that came out in the course of the research, or something I was aware of, and then we got into it a little bit more detail, was that when you look at certain government service workers who are dealt with under Article 18 of the tax treaty, these would be the type of workers who are sort of higher level civil servants, local authority workers, and workers who in educational establishments which are majority funded by government. So schools and universities, etc. Those employees are only taxed in country of payment, generally. That's what the Article 18, basically the relief under Article 18 of the treaty says, that they're taxed through the payroll in the country of payment, that's where the employer is, and they're not taxed in their home country on that. So if they are a cross-border worker, then they'd only ever have tax through the payroll where they're working, they wouldn't have tax in their home country. But if they work in their home jurisdiction and they're a resident and a national of that home jurisdiction, then 100% of the tax obligation can shift to the home jurisdiction. There's other little complications in there as well, but basically, they're kicked out of that relief under Article 18 and they're back being a normal worker for the purposes of Article 15 of the treaty. And if they are a resident and a national of their home jurisdiction, then the whole obligation for the payroll can shift into their home jurisdiction. That's more straightforward than been going on dual payroll, though. So it seems to be a lot more straightforward for government workers than it is for your ordinary private sector worker. So it simplifies it entirely for government workers, and that 100% can be either in the employer jurisdiction if they're commuting to work, or 100% in the home jurisdiction if they're working from home. part of the time even. So that's sort of draws a comparison between public sector and private sector there, and you'd wonder about that disparity. Now, really in taxation, employers are looking for simplification of the rules to avoid all these complications. And I think one of the biggest ones is to avoid dual payroll and potential PE exposure. Now, these are two big issues that are being looked at global level, not just here in Ireland. And the OECD is looking at both of these. They're looking at potential PE exposure first in 2025, and then move on to the employer requirement of the dual payroll potential requirement in 2026. And what the OECD usually do then is they give guidance in relation to how treaties could be amended or worded in relation to those things. But in the interim, when we've just consulted the Irish government in relation to this on a number of occasions, what they've basically told us is that they were sort of tied by the EU, that they couldn't really move without the EU, so giving them sanction to do so. But the EU has said to every country can go off and do their own bilateral arrangements. So there's no real, there's no block there to Ireland going off and making a bilateral arrangement with the UK in relation to this. It's up to the two governments, the departments or two civil services to get together and do that. In all of we talk about information failure at the start of this, in all of the guidance, both north and south of the border, there are no land border examples in the government guidance in relation to employer taxes and the PE issue. None of this comes up in terms of proper examples. They're all about the global scenario, not about the local. And it's sort of a question mark in my head as to why government service workers are treated more favourably. I mean, surely all cross-border workers should be treated equally. So if it can be simplified for them, why can't it be simplified for everybody else? So all the tax and the pension rule changes as well. When we're looking at legislation, I really think they should be border proofed, and that that the workers' position both directions should be considered. So that NI resident workers' position is considered. When there's new legislation coming in, and vice versa in Northern Ireland, that IE resident workers' position is considered. And one of the things that we talked about at length, I think, Annmarie, was that frontier workers should be recognised in all legislation, not just tax legislation. They are a cohort of workers in everywhere that has a land border. You're going to have frontier workers, people who cross the border to work, or work for an employer on the other side of the border. So they really should be recognised. Now, what we looked at as part of this research was, what are other countries doing? Since there's no blocker to us going and doing a bilateral arrangement with the UK, then what are the other things that other countries have done? So as recently there as December 2023, the Belgium and the Netherlands decided to come to an agreement in relation to the potential PE exposure that an employee could create by working in the other jurisdiction. And so their agreement included reference to a 50% threshold. So when the employee spends less than 50% of their time carrying out duties in their state of residence, that wouldn't create a permanent establishment for the employer who's in the other jurisdiction. But if they breach the 50%, it could potentially create a PE exposure. And then the next one that we looked at was Spain. And you'll see what the theme running through all the ones I'm going to look at now is that the theme is to flip the employee and their taxation into country of residency where they can, to simplify matters. So cross-border workers who are resident in Spain and travel daily to work in France, then under the terms of their agreement, wages they're paid to them where they're resident in Spain are only taxable in Spain. And on the French side, again, the wages are only taxable in France if they're resident in France. So you can see the theme that's developing here. And the next one we looked at was, Switzerland. Switzerland's a little bit more complicated because it's broken up into cantons, a bit like counties or areas, shires. So Switzerland, looks at the cantons that are closest to the borders. And so the border region with France and the border region in Switzerland, so the cantons that are closest to it. And if you happen to work in the particular cantons, then you're taxed, and you're French resident, you improve that, then you're taxed in France, and if you're a Swiss resident, you're taxed in Switzerland. Get my S's mixed up. So I want to move on there, please, Lisa. And then Belgium, they also had they've amended their tax treaty on cross-border workers between France and Belgium. And so the employees who became a cross-border worker before January 2012, the cross-border worker regime will still apply up to 2033, provided your permanent residence remains in the French border region. Until that time, there's no major interruption to it. And you work in the Belgian border region and you don't work outside Belgian border region for more than 30 days. So again, it's showing that thing that most countries want to tax you in country of residency rather than country of employment, where possible, if it simplifies things, where you're a cross-border worker. Do you want to move on, Lisa? Germany, again, if you're considered a cross-border worker and you work in the certain areas, which is the zone, the Alsace region, you have to work for the private sector company, and then you return home at the end of each workday. And if you're considered a cross-border worker, you're only taxed in Germany, and that's the case, or only taxed in France, where that be the case where you're a resident there. So the agreements, as I say, are all trying to simplify what we see on a day-to-day basis here between Ireland and Northern Ireland. And it's likely that that's the sort of thing that we're going to look for from the government departments on both sides of the border as to how we simplify the matter here. I think there's one left there. Is it Italy, Lisa? Yeah. So if you're considered a cross-border worker in Italy, you're liable for tax in your country of residence and not the tax, you're not taxed in your country of the source of your income where the employer is. And that's obviously is the exception to the normal rule where you commute to work across the border. You're normally taxed in country of employment. I'm going to go on and then consider some of the other issues in relation to pensions and portability, and then John will pick it up in relation to the drawdown of pensions and the complications there. So one of the areas that seemed to come as a surprise to some of the government departments we talked to was about the fact that cross-border workers are often excluded from the tax reliefs on pensions. So the significant challenges in relation to pensions is not a level playing field at all between cross-border workers and non-cross-border workers. So you've got a lack of tax relief and contributions, and I'll discuss that in a little more detail. There's potential taxation of employer contributions as a benefit in kind. John will deal with the clarity on what's going on with pension pots on drawdown. There's also some issues around auto enrollment. And then from an employer point of view, there's a real impact on business here, because when you've got cross-border workers, you could have unequal employee benefit packages, etc. When you're offering your pension contributions as part of the benefit package. And then from the employee's point of view, there might be reduced opportunities or just really poor opportunities to save for retirement in a tax efficient way. And it can arguably be considered a poor investment for cross-border workers. So let's deal with the tax relief bit first. So the tax relief and pension contributions, the way that normally works is that you get tax relief through the payroll if you pay your pension contribution through the payroll, or through self-assessment if you're a self-assessed taxpayer and you make a contribution outside of the payroll. But the tax rules for cross-border workers only allows tax relief in certain circumstances. So this limited. You've got migrant member relief, which basically means you've changed your residency, but you've continued to contribute to the scheme you contributed to before you change your residency. In that particular scenario, you could and in that particular scenario, you wouldn't get relief if you'd moved pension scheme, but if you continue to contribute to the same one, you potentially get that relief. But you have to change residency to do that. Most cross-border workers are not changing residency because they change jobs. The other one is the treaty relief under Article 17A of the DTA. I think I dropped the A there. Their employees posted across the border to work for the same or connected employer and continues to contribute to the same pension scheme to contribute to before the posting, they're allowed to continue getting relief. But in most cases, if you're posted across the border, there mightn't have been a pension scheme in place, or you're now no longer entitled to contribute to that pension scheme. So again, there's limited use of that relief. So, but if you happen to be in the normal sort of typical scenario that we come across, where you live one side of the border and work the other, then there generally isn't tax relief available in your pension contributions. So oftentimes the pension contribution will be made through the payroll, and tax relief is given automatically through the payroll. But when that individual comes to return it on their self-assessment return in their home country, in the jurisdiction of residency, that's where the relief isn't available. And you'll find that they've got a top up to pay. So a lot of people who took up maybe very well paid jobs south of the border, but they live in Northern Ireland, and thought that the pension contributions they could bump up their pension contributions because they're getting paid better south of the border. And there's a fine line between how much pension contribution they can make and then where the tax relief is going to stop when it comes to getting relief north of the border. Since the tax in the USC are higher south of the border, usually it masks the fact that you've made a pension contribution, so you're getting your credit and you're up to the same level of tax payable north of the border. You're usually getting a little bit of relief. But say somebody makes an AVC contribution, then the AVC contribution can often push them into a tax payable situation north of the border. when it's going the other way around, where an individual is claiming trans-border workers relief, that can mask the fact that they haven't got tax relief on their pension contributions. But basically, if they're they do commute across the border every day, satisfy all the conditions, and have no other sources of income, there's no further tax to pay. So the fact that they made a contribution to the pension north of the border doesn't come into it. It sort of masks that. But take away that trans-border workers relief if they work from home, for example, and suddenly now you've got a bigger problem. They've made contributions north of the border, and their tax credit from their employment north of the border is less than the equivalent tax in USC. So they could have quite a big top up to pay to the Irish revenue, and that's a real problem. Next slide, please, there, Lisa. The employer pension contributions can be an issue as well. So it's more straightforward on the northern side of the border, where usually an employer pension contribution is not taxable under Section 307. But south of the border, the contributions that an employer makes to a pension scheme on behalf of an employee could be treated as a benefit in kind. And there's only specific legislative exclusions from the charge, and they don't always apply in your typical cross-border worker scenario. Just pop to the next one, please. So the exclusions, say, for Northern Ireland residents with an IE employment, I say 307 NITEPA normally says that they're not subject to tax and not a BIK. But obviously there's if they exceed the annual allowance, or when the members received a distribution, that can take them out of that, and they actually could be taxable. They don't follow the 307. However, there's no clarity yet in relation to auto-enrollment, and the Irish auto-enrollment scheme, which is coming in, it's now postponed. It could be January 26 or before that, but it's postponed from September. That if you're an NI resident cross-border worker, how are the state and employer pension contributions going to be treated under this new auto-enrollment scheme? No clarity on that yet. Let's move on there, please, Lisa. If you're an Irish resident with a Northern Ireland employment, then the only exclusions from the BIK charge, if the employer has made a contribution for you into your pension, so the charge and the employer contributions, with either the salary is not chargeable to tax in Ireland, which would be highly unusual. Usually if you're a resident here, it is chargeable to tax, but you take credit for the taxes across the border, or the worker is not domiciled in Ireland and does not remit the salary income to Ireland, because all their duties were abroad or in Northern Ireland, and if they didn't remit their salary at all, then they wouldn't be taxed on it here. So therefore, they wouldn't be taxed on any employer contributions anyway. But the recent ESRI survey that was published before our report found that 55% of cross-border workers travelling from Ireland to Northern Ireland earned less than 50,000. And I don't know many people in that bracket who don't have to remit their income to live on. So I think most of them do. So they're unlikely to fall within these exclusions. So that means that potentially there's an exposure there for some employees who are cross-border workers, that if the employer in the north has made a pension contribution on their behalf into the scheme, they're potentially taxable south of the border. Can you move on, please? Is that the same one? Oh, yeah, so yeah. And then we contrast that to the pensions of the government service cross-border workers covered by Article 18. They've been treated more favourably. So NI employer contributions for an Irish resident government service worker who commutes to work every day, they're not working from home, they're not taxed by virtue of our Irish legislation under 778. And you wonder, why is that they're being recognised but the other workers aren't? Why is there a disparity there? It's clearly a piece of legislation that covers them. Why can't we have similar legislation for ordinary cross-border workers? So I keep trying to move the slides on, Lisa, that's all right. This is the bit where I'm going to hand over to John, and John's got a nice colourful slide, unlike mine. And he's going to talk us through drawn down of pensions. He's an expert in this area. So I'll hand over to John.
Hi, thanks, Rose. Yes, name is John Lucas, and I suppose if we could do one slide on cross-border pensions from our point of view, this would be it. I have a financial services practice based in Monaghan, and just by virtue of our location, we come across quite a lot of the cross-border pensions and the issues that we're going to talk about today. The bottom line on this is every jump is basically different. It starts at a different point. Every client is different, and every circumstance has to be looked at in context. And unfortunately, the rock moves. So that's the starting point. a little bit about ourselves is we have an office here in Monaghan and Carrickmacross. We've also office down in Limerick and Galway. I started off my existence as a pensions consultant, working with Standard Life, and that's relevant because in 1999, Charlie McCreevy changed pension rules, which basically brought in ARFs, which meant pensions didn't die with you. You didn't have to buy an annuity anymore. Now, they were brought in for self-employed and for company directors, but they weren't for employees. It created a loophole where you were able to bounce a pension to the UK, use CUROPS legislation and bounce it back and get ARF options. Now, I'm going to touch on that, but it is relevant from my point of view because it allowed me to become quite familiar with the cross-border legislation. So some of the things that we do know for certain are what came out there in January 1st, 2023, that lump sums from Northern Ireland pensions are now treated exactly the same as lump sums in Irish pensions. So the first 20,000 is tax-free, the next is 300,000 is taxed as 20%, and we know that. But what happens literally about the next 75% remaining? So maybe move on to the next slide. So what is really critical in this is that the timing is really important. Once the tax-free has been taken in either jurisdiction, it has to stay there. So if you have somebody who has a pension in the north and they draw it down, that goes into drawdown. You cannot transfer a drawdown pension across border. So that is a real issue. So if you are transferring country residency, do it before you draw your pension down. This is because ARFs, which is the Irish version, don't exist in the UK, and the pension posts in the UK can't be moved into the ROI as there's no equivalent product. So if you're drawing this down, it is really crucial that every case is examined individually and you consider when and how do you draw this down. Absolutely crucial. So the CUROPS transfers are what we see quite regularly. So I'm looking at this from an Irish ROI basis, where we would have clients coming to us who maybe have pensions in the north. Maybe they worked across the UK or the north, and the pots built up. The CUROPS, I don't know if you want me to go through this, Rose. Do you want me to go into CUROPS briefly or not? I'll keep going. So the CUROPS is a designation. I'm sure you guys all know what it is. It's an overseas recognised pension scheme that applies UK rules to an Irish pension, or in this case, an Irish pension. So why it was introduced was basically the HMRC introduced a 25% overseas charge in the UK Finance Act in 2017. We'll just move to the next slide. What this meant was that after 2017, if someone was over 55 and they used the CUROP option, they could transfer a UK pension to ROI and draw it down, provided the individual was over 55 and they'd been non-resident for 10 years. It didn't. So basically, the pension here didn't talk to the pension in the UK. There were different rules if that was before that. So this then brought in a couple of query, opened several cans of worms in relation to pension caps in the UK. So if an individual is lucky enough to have a previous pension pot in the UK maturing of 600,000 and a current pot of 600,000, there's various different implications around that. If they're going to be living ROI, they could actually potentially move that pension back here, but all of a sudden then you're going to say, well, actually, if they move it back here and they pop their clogs, the estate will receive that pension. If they decide, no, I'm going to leave the pension in the UK, they draw it down, they take the 25% tax-free. What happens in the event of their death to the pension that is overseas or in the UK? Because as we said earlier, you can't transfer a drawdown pension in the UK to an equivalent product here. and vice versa is the case. So the timing around this is huge, and every case is literally different. And we see this as from the ROI resident and not the other way around. So yeah, it really is a minefield. Like I said, that person jumping off the cliff, they're jumping from a different place every time. Depends on their age, depends on size of the funds, how long they've been living away, when did they move back, and the rules are changing all the time. So maybe move on to the next slide. Pension entitlements and portability. So Northern Ireland residents with an Irish pension pot on retirement, there's a lack of, in a surprise move, there's a lack of clarity on the Northern Irish tax of Irish pension pots, such as the non-index linked ARFs. I'm not going to go into that too much. There's also appears to be a double taxation on transfer of PRSA. So a PRSA is a type of pension that has been favoured here south of the border, and new legislation has been brought in to favour those over executive pensions. If somebody tries to move a PRSA north of the border, it is subject to PAYE, moved to the UK and then taxed again. So not particularly attractive. In Northern Ireland, lump sums from Irish pensions are mostly taxable. If part of the pension fund was accumulated prior to the 6th of April 2017, then a portion of the fund can be treated as not taxable. The benefits of accumulations from the 6th of April 2017, there are differing tax treatments depending on the type of foreign pension scheme. Therefore, if it's an IE pension meeting certain conditions, then it may benefit from the 25% tax-free rule. Move on to the next slide. So for Northern Ireland residents with an Irish pot in retirement, it does not meet the conditions, then it would not benefit from this 25% tax rule. Northern Ireland resident may be limited to taking an annuity. Obviously, this dies with them and it's not particularly attractive. This is because, as we said before, there are no ARFs in the UK. Many cross-border workers have found pensions to be a bad investment for this very reason. Also, there are other issues in this. Is that if, say, somebody had built up a sizable pension in the south, and they then wanted to move it into to the north, the problem there, and they moved to the north and then wanted to then access their benefit, you'd think that would be simple, but it's not, because in order to buy a product south of the border, they have to be resident. So if you speak to some of the life covers companies, Standard Life, New Ireland, Irish Life, they are licensed by the Central Bank of Ireland to sell product to residents. So if they're non-residents, they can't actually sell the product. So that's a problem that maybe isn't a taxation and a legislation problem, but it's a regulation problem that is governed to the life companies. So many cross-border workers have thus found pensions to be bad. They can't make them work for them. So employers, employees, and pension advisors are asking for a simpler regime where it's clear from the outset whether tax-free lump sums can be obtained from the fund, and indeed there's a degree of succession planning in place as well. You can move one product to another. There should be a clearly laid down guidelines as to how Irish pension pots, such as non-index linked ARFs and personal retirement savings accounts for cross-borders, will be taxed in Northern Ireland. Unfortunately, I believe the PRSAs, there is a little bit more clarity now, and it's if you move a PRSA cross-border, it's PAYE. It's hit with full tax. And this was just a little slide that I found somewhere, and it's basically showing the complexity of the pension regime in Ireland. So the ideal pot for moving pensions to the UK is through the BOB. It's called the buyout bond. But actually getting into the buyout bond isn't necessarily the easiest. So you can't move a personal pension into a buyout bond, and you can't move a personal pension into an executive pension, but you can move. So I won't go into it. That was maybe slide is if we have any questions. I might refer to that later on. So yeah, that's over and out from myself. Thanks, folks. Oh,
The audio, put the audio back on. So I was going to talk about the auto enrollment and what's going on with it. So we've had, obviously in Northern Ireland, there's been auto enrollment around, I think since 2012 roughly. And there's nothing to prevent an Irish resident worker from joining their auto enrollment scheme. But employees now are sort of getting more familiar with what's going on and asking questions about it. Very concerned that there appears to be no guidance to how the NI auto enrollment for cross-border workers should be treated from a tax perspective. See, because you've only got these limited reliefs that I mentioned earlier, the migrant member and the treaty relief, and most cross-border workers don't qualify them. So they've technically not been entitled to tax relief in Ireland on any contributions through the payroll in Northern Ireland, in a lot of cases. So this apparent legacy of non-compliance applies across the border on pensions, and it's a direct result of these issues not being addressed at legislative level and this information failure we mentioned earlier. So we do need some clear, concise guidance as to how this should be dealt with. If you think about the number of companies now that would have auto enrollment schemes in place north of the border, but they've got a lot of Republic of Ireland resident workers, and they may be totally unaware that either the standard government answer we got when we raised this issue was, well, they can opt out. I'm thinking, well, what's the alternative for them if they're not going into their auto enrollment scheme, then they need to be offered an alternative. So the lack of compliance there, I think, is going to have some legacy issues. Can you move on there, please, Lisa? The new auto enrollment called My Future Fund, which is due to come in, was September, but now I think been pushed out to January 2026. It's structured differently to the Northern Ireland auto enrollment scheme. So the structure of this one is that the employee doesn't get tax relief and contributions, but both the state and the employer will make contributions to the scheme. But there's no indication, and we've asked the question in the course of the research, as to whether or not the NI resident employee situation has been covered in this. Has that been considered at all? So based on current rules, they wouldn't be entitled to tax relief unless they fell into one of the migrant member or treaty relief provisions we talked about, so that they wouldn't be entitled to tax relief on their own contributions, and they could be taxed on employer contribution as additional salary or benefit in kind unless they specifically come under that Section 307 ETEPA that we talked about earlier. So this really needs clarification, and it's something we did ask for, but we haven't had any clarification on this yet. But again, what we're lacking here is the real guidance. Concise, relevant examples, guidance of land border scenarios should be made available to all employers and employees. It shouldn't be a case of we're scratching around for that information. So next slide there, Lisa, please. So really what employers and employees affected are calling for is that there's a reciprocal recognition of equivalency. So, that people aren't treated differently just because of the circumstances they're in, that they're a frontier worker, they're a cross-border worker, they're a cross-border employer. The tax relief should be available on employee pension contributions in their home jurisdiction. There should be clearly laid down guidance as to how pension pots and non-index linked ARFs that we talked about and PRSAs are going to be taxed. And there should be clear guidance that tax relief is available on in Ireland on contributions to NI auto enrollment schemes, and the employer contributions of such schemes are not taxed. And likewise, the employer and state contributions are not taxed in NI residents of Irish auto enrollment schemes as well. So I suppose we're asking for a lot there, but in the scheme of things, is it a lot? I'm not sure that it is. I think it's something we need to be asking for, and I suppose we're talking to different bodies at the moment in relation to this. Is there the next one, Lisa? I can't remember the order of the slides. Yeah, I suppose maybe Annmarie, if you want to take this up now as to what's coming up next. This is a series of seminars that we're running out of the cross-border Centre for Cooperation. So Annmarie might be able to talk us through. We've already done, this is number 2 list, and Annmarie can talk us through what's coming up next.
Yeah. So look, that was brilliant. Before I even mentioned the other ones, can you hear me okay? I was having trouble unmuting. Okay. So look, first of all, thank you so much to the two of you for sharing all of that knowledge. The financial workers that are on the call, people from the sector and workers and employers are obviously wading through really, really complicated, highly complicated areas. So we will move on to a Q&A session and a bit of a discussion that we won't but first of all, yes, I want to mention the number of webinars that are going to take place between now and the end of June. So the next one will take place, I think it is, I can't see the slide on my screen, whatever's happening.
29th of May.
Yeah, I think it's the 29th of May. So that one will look at skills and qualifications. If you keep an eye on crossborder.ie, you'll get lots of information about the next, about the order of the next webinars. All of them will lead into and help to shape the format and the programme of the Centre's annual conference, which is due to take place in September the 18th in Dundalk. So please do add that date into your diary. It's going to be a solution-seeking event, and I'm really looking forward to that one. But we do have a lot of representatives from the sector, financial sector, on the call today. So it would be really good if we could generate a collective cross-border wish list of the solutions that we think could help ease the burden here and to help this place to flourish. So we'll carry on with the discussion now, but first of all, we're going to pause the recording for this bit. So Lisa, if we could pause.